The speed of Enron's decline simply stunning. Shares traded at more than $80 a year ago. Tonight, 61 cents a share. $62 billion of shareholder value wiped out.
In November 2001, thousands of employees rushed to pull out their retirement savings. The button didn't work. Not because the system was broken, because the company had locked them out. For 3 weeks, they sat at their desks and watched their life savings disappear, $1 at a time, while the executives who had told them to buy more were selling everything they had. It was an American company, $70 billion in market value, 21,000 employees, operations on 6 continents, 16 years old, named Most Innovative Company in America 6 years in a row by Fortune magazine, including the year it collapsed. The company didn't shrink. It didn't restructure. It didn't get caught by a regulator. It got caught by a journalist. A reporter at Fortune, the same magazine that had been putting it on the cover, wrote one article. The article asked one question. The question was 6 words long. And every analyst, every auditor, every lawyer, every banker, every board member, 25,000 sophisticated people who had spent a decade signing off on the company's books, had never asked it out loud. Because asking it would have made them look stupid.
December 2nd, 2001. That was the day Enron Corp filed for what at the time was the largest ever corporate bankruptcy.
Biggest case of corporate fraud in history.
2001, the company's stock price took a dramatic dip from $90 to just 26 cents.
They fought a good fight, and some things work, some things don't.
Here's something most people don't understand about fraud. The biggest ones don't happen in the dark. They happen in the gaps, the spaces between rules. The moments when an industry that used to be one thing becomes something else, and the rulebook hasn't caught up yet. The story we're about to tell is the story of one of those gaps. In 1985, the United States deregulated natural gas. Until that moment, energy in America had been a utility, regulated, predictable, boring. Margins were fixed. The companies that owned the pipelines were not interesting. Nobody was particularly rich. Deregulation changed all of that. Suddenly, energy could be traded, bought low, sold high, hedged, speculated on. Suddenly, a barrel of oil or a cubic foot of natural gas could behave like a stock instead of a faucet. That same year, 2 pipeline companies, Internorth and Houston Natural Gas, merged. The new company was named Enron. A consultant had been paid to invent the name. It was supposed to suggest energy and innovation. Originally, it had been spelled enteron, until someone pointed out that the word enteron refers to the digestive tract. The te was quietly removed. That was the first thing the company quietly removed. It was far from the last. Kenneth became the CEO. Lay was a former government economist with a doctorate from the University of Houston. He had worked for the Federal Energy Regulatory Commission. He understood, better than almost anyone alive, how the regulatory machinery of American energy actually functioned. And he understood something else. The deregulated market that had just been handed to him had no rule book yet. There was no precedent for how an energy company should account for a long-term contract. No precedent for what counted as a hedge. No precedent for what could and couldn't be moved off a balance sheet. The United States Securities and Exchange Commission had not written those rules, because until 1985, there had been no need. Most CEOs would have waited for the rules to arrive. Lay decided his company would help write them. Over the next decade, Enron would become the largest political donor in the energy sector. It would lobby for the Commodity Futures Modernization Act of 2000, a law that exempted energy derivatives from federal oversight. It would convince the SEC to approve an accounting method that no energy company had ever used before. It would, by the late 1990s, have such deep relationships inside the Bush administration that Vice President Cheney's Energy Task Force would meet with Enron executives 6 separate times in a single year. This is not a story about a company that broke the rules. This is a story about a company that wrote them, and then broke them anyway. There are 2 documents in this story. The first is an annual report, public, filed with the Securities and Exchange Commission, available to anyone with an internet connection. Inside its footnotes, not hidden, not encrypted, printed in the same typeface as the rest, there is a number that describes, in technical language, the entire mechanism of what you're about to watch. The second is a 7-page memo, internal, written in August 2001 while the fraud was still operating at full speed, by someone inside the company who had read the same footnotes and understood what they meant. The memo predicts the collapse, by name, 6 months before it happens. It names the structures. It names the risk. It names the outcome. Both documents existed at the same time. Both were read by people in positions to act. Neither stopped anything. The question of why? That is this story. In 1990, a consultant from McKinsey & Company joined Enron. His name was Jeffrey Skilling. He had a Harvard MBA. He had a reputation inside McKinsey as one of the smartest people anyone had ever worked with. And he had an idea that, in 1990, sounded like science fiction. Skilling said, "Don't own power plants, own the contracts." He called it asset light. The idea was that the future of energy wasn't in pipelines or refineries or generators. The future was in financial intermediation, standing between buyers and sellers, writing the contracts, taking a percentage. It was the kind of thesis that made a McKinsey deck look brilliant. And in 1992, Skilling did something nobody in the energy industry had ever done. He convinced the Securities and Exchange Commission to let Enron use an accounting method called mark-to-market for its long-term energy contracts. Mark-to-market. Here's how it worked. You sign a 20-year contract to deliver natural gas. Traditional accounting says, record the revenue each year and get paid each time you deliver the gas. The revenue arrives when the cash arrives. The math is boring and honest. Mark-to-market says something different. Mark-to-market says, estimate the total profit you will make over the next 20 years and book all of it today. The profit was a projection. The projection was a model. The model was an assumption stack. Assumptions about future gas prices, future demand, future interest rates, future regulations, future weather. You could not verify any of it, because the future had not happened yet. And the SEC approved it. Inside Enron, the moment that approval came through, the company became a different kind of business. Traders who signed contracts got paid bonuses on the projected profits, cash bonuses, real money, for revenue that, in many cases, would never actually arrive. The longer the contract, the bigger the projected profit, the bigger the bonus. Traders started signing 20-year deals, then 30, then 50. There was no penalty for being wrong about the projection, because by the time the projection failed to materialize, the trader had already cashed the bonus and moved to a different desk. But Skilling didn't stop there. He created a system called the Performance Review Committee, internally known as Rank and Yank. Every 6 months, every employee at Enron was ranked. The bottom 15% were fired. Every 6 months, no exceptions. The system selected with mechanical precision for one trait, closing bigger deals at greater complexity. But the SEC approval was only the beginning. Once you've booked 20 years of profit in a single quarter, what do you do in the next? You have to find a way to book more, and then more, and then more, forever. Which works, as long as the projections hold. When they don't, there's a gap. And where do you hide a gap? Not the income statement. Wall Street is watching. not the balance sheet. The credit agencies are watching. The gap had to go somewhere nobody was watching. Here's what you need to understand about how they hid the gap. They didn't. Enron disclosed it. Every year, in the footnotes of its annual report, the same document the SEC had reviewed, the same document the board had approved, the same document Arthur Andersen had signed, there was a line item. It described, in standard accounting terminology, the structure of what was being built. Legally compliant, publicly available, technically accurate. It used language that any CPA in America could have unpacked in 40 minutes. Nobody asked what it meant. The gap didn't go somewhere hidden. The gap went somewhere everyone could see, and nobody would look. His name was Andrew Fastow. He was sharp, ambitious, and obsessed with what he called financial innovation. Inside the company, he was known for being able to structure deals nobody else in the industry could structure. Outside the company, CFO Magazine would give him their CFO Excellence Award for, quote, capital structure management. The award was real. The capital structure was a fiction. Fastow's instrument of choice was something called a special purpose entity, an SPE. Here are the mechanics. Here's how it worked. Imagine Enron has $1 billion of debt that Wall Street doesn't like to see on its books, or a power plant in Brazil that's losing money every quarter. These are problems, and Wall Street punishes problems. So Fastow creates a new company. On paper, it's separate from Enron. Different name, different legal entity. Let's call it Raptor. Enron sells the $1 billion debt to Raptor. Enron sells the failing Brazilian power plant to Raptor. Just like that, the debt is gone from Enron's books. The losing asset is gone from Enron's books. Enron looks healthier. The stock goes up. But there's a problem. Raptor doesn't actually have any money to buy these things. Raptor is a shell. So Enron has to lend Raptor the money to buy Enron's own debt, which means the debt didn't actually leave. It just moved across the room. And to make the whole thing look legitimate, Fastow added one more layer. He took Enron's stock, the company's own stock, and used it as collateral to guarantee that Raptor could pay back what it had bought. So now the structure looks like this. Enron's debt is being held by a separate company, which is being funded by Enron, which is being guaranteed by Enron's own stock. Nothing was actually transferred. Nothing was actually sold. Nothing was actually hedged. The risk had just been moved to a room with the lights off. And as long as Enron's stock kept going up, the entire structure held. Over the next 3 years, Fastow created over 3,000 of these entities. He named them after Star Wars characters: Chuko, Jedi, LJM-1, LJM-2, Raptor 1, 2, 3, 4. This was not a mistake. This was the culture. Inside Enron, the names were treated as cleverness. Look how smart we are. We're naming our off-balance sheet entities after movies. The auditors don't even understand what we're doing. In June 1999, Fastow walked into a board meeting and asked for something extraordinary. He asked the board of directors of Enron to waive the company's code of ethics. Specifically, he asked for permission to serve as chief financial officer of Enron and as the managing partner of LJM, one of the off-balance sheet entities Enron would be transacting with. He would be on both sides of every deal. He would negotiate as CFO of Enron against himself as partner of LJM, and he would personally profit from both sides. The board approved it. Not reluctantly, not with conditions that were actually enforced, in a single afternoon. Over the next 2 years, Fastow would personally make $45 million from LJM. while serving as chief financial officer of Enron. When investigators later asked him how he had justified it, his answer was simple. The board approved it. The auditors signed off. The lawyers reviewed it. He wasn't wrong. They all did. There's a specific failure that occurs when institutions are paid to check something. They are also paid not to find wrong. It doesn't require corruption. It doesn't require stupidity. It doesn't require bad faith. It requires only that the cost of finding the answer be higher than the cost of not looking. Enron engineered this condition deliberately, across every layer of oversight, simultaneously. The result was not one institution failing. It was every institution failing, in the same direction, at the same time, by the same logic. This is what that looked like. The Enron board included a former dean of Stanford Business School, a former British Secretary of State, a former chair of the Commodity Futures Trading Commission, and the president of one of America's largest cancer research centers. Each was paid $350,000 per year to provide oversight. They approved Fastow's conflict of interest waiver. They approved 3,000 off-balance sheet entities. They approved quarterly earnings reports built on projections none of them independently verified. Their defense afterward was uniform. We relied on the auditors. The auditor was Arthur Andersen. Andersen was one of the big 5 accounting firms in the world. Founded in 1913, 90,000 employees globally. A reputation for integrity so deep that the phrase Andersen audited was for most of the 20th century a guarantee. Andersen earned $52 million per year from Enron, $25 million for auditing the books, $27 million for consulting on how to structure them. The conflict was the business model. Andersen employees were physically embedded inside Enron's offices in Houston. They had desks. They had email addresses. They went to Enron's company parties. They were, for most practical purposes, Enron employees who happened to also be Enron's auditors. In 2001, an Andersen partner named Carl Bass raised internal concerns about the SPE accounting. He flagged it through the firm's professional standards group. Enron found out. Enron called Andersen and demanded that Bass be removed from the account. Andersen complied. The next layer was the lawyers. Vinson & Elkins was Enron's primary outside counsel. They reviewed and approved the SPE structures. They wrote the legal opinions that said the structures were permissible. When the company's own internal whistleblower memo, later in the story, would warn of imminent accounting collapse, the company would hire Vinson & Elkins, the same firm that had approved the structures, to investigate them. They cleared the company. The next layer was the banks. Merrill Lynch, JP Morgan, Citigroup. They didn't just lend Enron money. They structured deals they knew were shams. The clearest example was the Nigerian barge deal. In December 1999, Enron needed to book $12 million in profit to hit a quarterly target. They didn't have a buyer for an asset, 3 barges with mounted power generators floating off the coast of Nigeria. So they called Merrill Lynch. Merrill agreed to buy the barges from Enron, $28 million. The transaction was booked as a sale. The $12 million in profit hit Enron's quarterly numbers. The market saw the earnings. But there was a verbal side agreement. Enron promised, off the record, to buy the barges back from Merrill within 6 months, at a guaranteed price that gave Merrill a 15% return. This was not a sale. It was a disguised loan. Merrill booked it as a sale anyway. So did Enron. The earnings target was hit. The bonus pool was paid out. The stock went up. 4 Merrill executives would eventually go to prison for this deal. The next layer was the analysts. Wall Street equity analysts, the professionals paid to scrutinize public companies and issue buy hold, or sell ratings, covered Enron continuously throughout the fraud. In October 2001, 6 weeks before the bankruptcy, 16 of the 17 analysts covering Enron rated it a buy or strong buy. The 17th rated it a hold. 0 analysts had a sell rating. The total value of the stock those analysts were recommending was, by then, mathematically impossible. But the analysts worked for investment banks. The investment banks earned fees from Enron. The analysts who downgraded Enron lost access to management. The analysts who lost access to management lost their reporting advantage. The analysts who lost their reporting advantage got fired. The system, with mechanical precision, selected for one trait: continue rating Enron a buy. So when investigators later sat down to reconstruct who had been responsible for catching the fraud, the answer formed itself. Investors believed the analysts wouldn't all be wrong. Analysts believed the auditors wouldn't sign off if it was fraud. Auditors believed the lawyers approved the structures. Lawyers believed the board had oversight. The board believed management knew what they were doing. And every single one of them was a sophisticated professional being paid a great deal of money to be the one who checked. None of them did, because checking would have meant asking the basic question: how does Enron actually make its money? And the basic question was the question that, in the rooms where these people worked, made you sound like the only person who didn't get it. But somewhere in New York, in a small office at Fortune magazine, a reporter who wasn't even on the Enron beat was reading the company's annual report. She wasn't a finance specialist. She had a degree in English literature. She was reading the document slowly because she didn't understand it. And she had started to notice that the more carefully she read it, the less it made sense. This pattern has a name. You'll find it and the Enron case file in the description. For now, the lights in California were about to go out. Literally.
Las Vegas Code, Jim. This is Rich.
Hey, Rich. This is Bill up at Enron.
Bill.
Good.
All right, shoot. I've got pen and paper.
All right, man. This is going to be a word-of-mouth kind of thing.
Okay.
Tonight, when you finish your normal QF, so for hour ending 1,
Right.
it'll actually be tomorrow.
Right.
We want you guys to get a little creative
Okay.
and come up with a reason to go down.
By the year 2000, Enron had built the most sophisticated trading operation in the world. Mark-to-market let them book the future as the present. The off-book entities let them bury the past. The board approved. The auditors signed. The analysts upgraded. The stock climbed. And then they found a new thing to sell. Not gas, not power. The shortage itself. In 2000 and 2001, California had the worst energy crisis in American history. Wholesale prices rose 800%. Pacific Gas and Electric went bankrupt. Southern California Edison came within days of it. The official story was that California had deregulated badly, that the system had flaws, that supply was tight. In January 2001, the governor declared a state of emergency. That was the official version, a state in crisis. It was partly true. It was also the cover.
Hey John, it's Tim. The regulatory is all in a big concern about is we're wheeling power out of California. He just steals money from California to the tune of... Can we rephrase that? Okay, he arbitrages the California market to the tune of $1 million or $2 million a day.
Inside a room in Houston, a handful of traders had worked out how to build the shortage by hand. The trick was simple. You control a piece of the supply. On the hottest afternoons, when the state needs it most, you take it offline. You call the plant. You say, shut it down. The supply drops. The price jumps. And you sell into the jump. Millions of dollars, one afternoon. On March 19th and 20th, blackouts hit 1.5 million Californians. On the same days, in the same room, the traders sold into the spike. They gave the moves names: Fat Boy, Death Star, Get Shorty, Ricochet. They named them after movies because it was funny.
What do you want to call this project? I have a catchy name for that. How about, something friendly like Death Star?
That 800% didn't stay on a screen. It came in the mail. Bills doubled, tripled. For some, worse. This is the part the documents don't show you. A number on a trading floor is abstract. A number on a kitchen table is not.
So the rumor's true? They're f***ing taking all the money back from you guys? All the money you guys stole from those poor grandmothers of California? Yeah, Grandma Millie, man. So she's the one who couldn't figure out how to vote on the butterfly ballot. Yeah, now she wants her money back for all the power you've charged jammed right up fucking $250 a megawatt hour.
He wasn't being figurative. There were grandmothers in California, sitting in the heat with the air off, because the men on the phone had decided a hot day was a buying opportunity. Businesses cut their hours, then their staff, then their lights. A spike that lasts a season can end a thing a man spent 30 years building. None of it was an accident of supply and demand. It was a product, designed, named, sold.
There's a fire under the core line. The DA from 45 to 2100. Burn, baby, burn. That's a beautiful thing.
The tapes weren't made public until 2004. By then, Enron was gone. The manipulation cost California an estimated $40 billion. But the dollar figure was never the worst of it. The worst of it was the woman at the table, under a light she could no longer afford. The mother with the bill. The grandmother who left the air off. The man who locked his door while it was still light out. They were not abstractions. They were who the strategy was run against. And here's the part the recording won't let you walk away from. We draw men like this as villains because it's easier than the alternative. A villain is a kind of safety. A villain wants something. Power, revenge, something you can at least call a motive. And as long as you can name the motive, you can tell yourself you'd recognize it. You'd see it coming. You'd never be the one in the room. These men had a bonus structure. They weren't deceived. They weren't pressured. They weren't following orders they didn't understand. They were ordinary. And ordinary is the thing we can't afford to look at, because ordinary is us. They picked up a phone. They called a plant. They told a man to shut it down on a 100-degree day. And then they laughed about the grandmothers. The horror of Enron was never that the people inside it were monsters. A monster you can spot. A monster you can stop. The horror is that monstrousness in the real world doesn't need a monster. It needs a man in a white shirt, a phone, and a number on a screen that climbs when somebody else's goes dark. The fraud was running at full speed, and inside the company, two people had already started to ask the question that would end it. One was a journalist. The other was sitting 3 floors above Skilling's office, writing a memo. Neither of them knew about the other. Both of them were about to find out what happens when you ask the question everyone else is being paid not to ask.